Hello and welcome to this video series where we're going to be talking about time frame selection and institutional workflow. So, what is time frame selection and why is this important to your study as a forex trader and your consistent success as a forex trader? So basically, time frame selection is key to long-term consistent profitability in trading. Time frame selection is about adopting a method of trading that suits your personality and lifestyle. So let's say, for example, if you're the type of person who is really impatient and you don't like to, when you take on trades, you want to see the trades pan out quickly. All right. So you're going to be someone who would be well suited for day trading than, let's say, an individual who wants to swing trade or even position trade. So your temperament or your type of personality and also your lifestyle when it comes to your career of work. Okay, so how often you've got free time during the day. So all of these all coming together to play a huge role or a factor um, in your time frame selection because now time frame selection is really underestimated when it comes to forex trading environment because there's just so many people are trying to do everything. They're trying to position trade and swing trade and short term trade and day trade and scalp. You're getting it all wrong because they're not, they're not trading the style that suits them. So when you as a forex trader, you want to trade a style that suits you, that suits your type of being. For example, I'm the kind of person whereby I'm free most days because I basically do forex, which is my main source of income. So um, and also I can be really patient when it comes to holding trades. At the same time, I can also go in and out of the marketplace quickly because I've got free time on my hands. So my style of trading is basically short-term trading to day trading to sometimes scalping. Okay, so these are all things I employ in my trading model, but rarely do I ever swing trade. I don't think I've ever position trade, but rarely do I ever swing trade. So it's mostly short-term trading and day trading that suits my style. So if you're a kind of person that you feel you can hold trades for 2 3 days, then short-term trades is gonna suit your style. If you're a kind of person whereby you want to go in and out of the marketplace quickly. Okay, so in out you're done. That's day trading for you or scalping. Okay, so if you're the kind of person you've got huge equity and you basically want to place trades and leave trades to run for months, right? You want to trade the fundamental underlying market conditions of a currency. Okay, so you could position trade and then you can so basically, that gives you a carryover trade, whereby it's all in the fundamental portion of this mentorship. So time frame selection is really important to your longevity and your success in trading. Okay, so if your style of trading is at odds with your personality, okay, you're gonna keep on getting things wrong and you're gonna get really frustrated trading when your style of trading is at odds with your temperament or your lifestyle, your work lifestyle. So you gotta factor all of this into your trade. So now let's go into the different uh, time frames for trading. So on the monthly chart, you got the position trading. So these are for long-term swings, trends in price. The weekly chart is for swing trading. Basically, you're trading the quarterly shift in the marketplace. Basically, it's the duration for like about 2 to 3 months. Duration of trading. The daily charts is for short-term trading module, which is basically trading for a couple of days to sometimes a few weeks. And also the 4 hour order less is what we utilize for day trading and scalping. So um, defining setups for your model. So what type of trader are you? Okay, well, again, all of this all comes in together to blend, and because all of these little things come together to define the type of trader you're gonna be. So when you're defining setups for your model, again, it is based on your temperament. So what style of trader are you? Are you a trend trader who like to follow the trend? That means you like to trade in direction of the trend, and you can trust the trend to be in play for a long time, and you can trust that trend and trade in direction of that trend. So being a trend trader means you're trading only in direction of the monthly or the weekly chart. Okay, or you could be a swing trader, meaning you're trading the daily chart, intermediate term price action. So you're trading quarterly shifts, you're trading daily time frame price movements. You're trading off daily bullish order blocks for longs, or daily bullish mitigation block for longs, or you're trading daily bearish mitigation for shorts, or daily torso for shorts. Okay, as a swing trader, and you're holding for a couple weeks uh, to sometimes months, trading quality shifts. Or you could be a contrarian trader, which means you don't like trading the trends because you feel like that's what everyone is doing. So I used to be that kind of person where if there's a trend in place, I was always trying to trade against the trend because my style of thinking was that if everyone's trading in direction of the trend, wouldn't the market makers want to take price against the direction of the trend? That was the way I used to think when I initially started learning about the market making method of trading, and I used to end up losing so much because I was just never comfortable trading in line with the trend because I was like, if everyone's all doing the same thing, why don't I go against them? So I always felt like I was smarter than everyone else, and I wanted to go against everyone else, and that led to me getting burnt in my account. So being a contrarian trader means trading reversal patterns at market extremes. So trying to catch extreme highs, extreme lows. This is basically you're gonna be a tourist kind of trader, and you're looking for the market to make um, a long-term high, and you want to position yourself to trade like that. So there's people who trade like this, and they're successful trading like this. Okay, so but this is not my forte. This is not my style of trading. Okay, so you want to select a model that defines your temperament when it comes to trading. So being a short-term trader means you're trading the weekly ranges, 1 to 5 days worth of duration. This is my field. This is where I really, really excel at. So the short-term trading the weekly ranges, that really is one of the most profitable ways to trade. Trading, positioning yourself to get the weekly low and trade and take profits at or near, very near the weekly high that will be formed. And this is oftentimes intra-week setups. And this is one of the most profitable style of trading. And then, of course, lastly, we've got day trader who trades intraday swing trading. So you're trading the swing trading, the intraday swings, be it the jitter swing for London session, where the market makes a false move against Asia's range and then reverses entirely, or New York session model, which is oftentimes going to be in line with the high or the low from during London session. So now going to institutional order flow. What is institutional order flow? What can we understand by institutional order flow? So this is where you're gonna have to take some notes because again we're gonna revisit some of the concepts that we've been through on the mentorship ready, which we're also still gonna revisit on module 2 of our mentorship. So now let's look at let's I want to talk about the paradigm shift when it comes to institutional trading. All right, so on the diagram you can see there, you can see that there's smart money, uh, which is liquidity provider, and then there's liquidity, which is basically willing or unwilling liquidity. Okay, so give me a second real quick. All right, so now it's important to understand that price is delivered to engineer liquidity for smart money. Okay, so if you're new to institutional price action concept trading, okay, what I do like to tell people is when you want to look at price, as you begin to go through this mentorship, when you want to look at price, you want to begin to look at price from the vantage point of the central banks. Okay, so now once you can understand the aims of the central bank, their goals, what they do, okay, once you know their playbook, you can then position yourself to trade in line with them. All right, so the Main goal of the central bank, the main language of the central bank is liquidity. Now, I want you to think, what are all businesses set up for? When you see business being set up, what is the main goal of that business that is being set up? Is it to give people free products? Is it to offer people free services? Or is it to make profits? What is it? Of course, it's to make profits. That's what all businesses are for. Okay, and it's even more important in the largest market in the world that is all about money. Okay, so now let's talk about what the central banks does. What are their functions? So the central banks regulate price. Okay, they create an environment for everyone else to speculate in. At the same time, the central bank book profits for themselves via pairing their orders with counterparty liquidity from other entities like the smaller investment banks, the smaller hedge funds, okay, retail like ourselves who trade the marketplace. Okay, so the smart money is gonna pair their orders with our liquidity. So underneath this, I kept willing or unwilling liquidity. So oftentimes most of this liquidity would be unwilling. That's people who do not want to give up their liquidity as a loss. Okay, they have no options because price reaches a level and they get stopped out in a loss, and that becomes a profit being booked by what I like to call the smart money. Very select few groups of central banks and huge large banks that move prices in the marketplace. So what you're seeing in the marketplace is prices that is being manipulated by the smart money. Those entities that actually move price. They're moving price because number one, their job is to regulate prices, and at the same time, they want to book liquidity. So they script the market, they control the market, they manipulate the market to grab liquidity from willing or unwilling participants in the marketplace. So price is delivered to engineer liquidity for smart money. I'm going to show you an example of a pound Aussie dollar trade I was looking at yesterday when I had had a blip of internet connection. Okay, and I was able to look at the charts. So you can see that this was a sell here. Now, when I was looking at this chart on GA, okay, so let's try removing the the session breaks. Now, when we're looking at price, we want to focus on the liquidity. Now, I want you to look at this. Okay, look at this. What is this called? Of course, this is an ODI in price. Okay, this is an ODI in price. What's going to be resting above that level? If this is an old daily high in price, what's going to be resting above that level? If this was an old daily low in price, what was going to be resting beneath this level? Liquidity. Okay, sell side liquidity. Price trades down into that level from this price range. Okay, watch. Price makes a smaller range here. The banks, the smart money, they deal inside this range to run out this liquidity. They book profit underneath this low. Everyone, okay, who bought this market or protecting their buyer sell stops underneath this low, they get stopped out. Who stops them out? Smart money. If smart money stops them out, they are booking their sells via this level. Once they go all the way back up, they recapitalize on old selling level to buy. Stretch out this range, old selling level to buy. Where's your next target? Buy side liquidity. Everyone who is selling inside this range, you're going to protect their stops they're going to protect their orders, via stops above the swing guy, the swing guy. What is smart money going to do? They're going to find a range, or they're going to create a range and deal inside of that range to run out the liquidity above the marketplace to book profits for themselves. So It come back into an old selling level, they buy, and where are they going to run out? The liquidity. Everyone who's selling inside of this protecting yourselves. All the funds and the smaller banks and institutions and the private brokerage clients and all of them, even retail selling inside of this range, they're gonna place stops above short-term high, short-term high. And guess what price did? Runs out the liquidity. Okay? Runs out this liquidity, runs out this liquidity, runs out this liquidity, and it gets back into this old range, which is a daily bearish order block, which is an higher time from resistance level. Okay? And guess what? The same thing you're seeing on the 1 hour time frame is the same key concept playing out on the smaller time frames. Guess what? We have a smaller range here. We have a 15-minute short-term high here. We run above the short-term high, get into higher time frame resistance level. Once we broke to the downside, there's liquidity underneath this low. There's liquidity underneath this short-term swing low. And that's where price is reaching for. Once we break under this, price is going to seek out the next points of liquidity underneath the swing low, underneath the swing low. So the market is all about liquidity, which is what the banks want. So by understanding points of liquidity, you can determine institutional order flow. By understanding the higher time frame points of liquidity, you can determine the higher time frame institutional order flow. Understanding the lower time frame points of liquidity and blending that with the higher time frame points of liquidity, you can understand the lower time frame institutional order flow. I just showed you an example on pound Aussie. Okay, we understood that longs were positioned inside of this. You guys saw me go in there. We traded this live together. We called longs in this. Right? Remember? Now we are taking longs. Where are we going to look to book profits? Like if the banks are going to do the same thing above old eyes, old eyes, because there's going to be buy side liquidity resting above that level. So once you understand that they've run out this sell side liquidity, all of the sell stops are now trapped. You're looking to run out the buy side liquidity. You know that your trend is bullish because institutional order flow is bullish. Institutional order flow is bullish because this is where the next one of liquidity is. This is where the next one of liquidity is. So this liquidity is going to attract price because that's where the banks are going to look to take price to. Okay? Now, once you understand this, you can then go into the smaller time frames and then begin to position yourself in line with the higher time frame trend or the higher time frame institutional order flow, which is now bullish. Because we understand that this is going to attract price to it. This is going to attract price to it because there are points of liquidity. Points of liquidity. So the smaller time frame, we're looking for opportunities to go long. Now, once we run out this liquidity, we've gotten to an higher time frame resistance level. We can expect a most likely short-term bounce from that level. In this scenario, a daily bearish order block. We just run out this liquidity, daily bearish order block. Okay, so even though we're still bullish, okay, we can see a short-term bounce on the smaller time frames. So now we can then go into the 15-minute time frame and then look at the smaller time frame institutional order flow. How are you going to know where the smaller time frame institutional order flow is going to be at? By looking at the points of liquidity. This is an higher time frame resistance level. We have a short-term breaking market structure. Where is price going to visit next? Liquidity. That creates a short-term bearish institutional order flow inside a long-term bullish institutional order flow. So don't get this confused. We have a short-term bearish institutional order flow, okay, inside the longer-term bullish institutional order flow. So price is gonna seek points of sell stops into the smaller range. Then eventually gonna get back in sync with the higher time frame order flow. That is how you arrive at the premise of where price is going to go to by understanding the points of liquidity because that's what the banks are going to aim for. Okay, that's what makes it institutional order flow. That's what gives it the term institutional order flow. Okay, so now we have a short term here. intermediate time right there. Excuse me. We have an intermediate time there. We have a swing low down here. Okay. Guess what we did? We ran through this liquidity. We've gone through this liquidity, even though we're longer term bullish. Okay. Even though we're longer term bullish, we've seen a retracement down to run out the sell stops. Okay, so if we understand that we want to get back in sync with our time frame bullish trend, and we know that again from our videos on discount and premium levels, right? If we're gonna get bullish, we're looking for a discount price points, and we know that price is gonna seek regions around this. We can get in sync with a smaller time frame trend because now we've run out sell stops above this range. We run out sell stops. There was no willingness in price to trade above this short-term high. Where is price going to seek next? Because you're seeing lower highs, lower highs, lower highs. Price is going to seek swing low, right? So we run through the swing low. Now, once we understand that if we're going to get back bullish in sync with the higher time frame trend, we need to get all the way down to our discount price level. We know that we still have between this swing high. Let's say, for example, this is where price was at. Okay, at this point, we still understand that we have between this swing high and the swing low as a range for price to reach for to the downside because this is our discount price point. This is our ultimate trade entry price zone from the low of this range to the high of this range before we get back in sync with the higher time frame direction. Okay, so now we can then expect that this swing is going to be a draw in price. This short-term swing is going to be a drawing price. The short-term swing is going to be a drawing price until we get back to an higher time frame support level. So that means we thus understand institutional order flow on a smaller time frame is going to be bearish because we have short-term liquidity to run, short-term liquidity to run, and we know that there's going to be higher time frame support for price to get back in sync with the higher time frame bullish trend. So we have the short-term bearish institutional order flow inside the long-term bullish institutional order flow. Okay, we're understanding the point of liquidity that we just ran out this point of liquidity. We're showing lower highs and lower lows. We're retracing back inside of this range, back to a support level. By understanding all of this and blending all of this concept, you can then arrive at your institutional order flow. And then you can see eventually price begins to get a sync with our time frame institutional bullish order flow. So that is institutional order flow. Once you understand the point of liquidity, understand that smart money is only going to seek for areas of liquidity that changes your understanding of order flow for you. Okay, that is institutional order flow. That is all you need to understand about institutional order flow. So, hopefully this webinar was insightful to you about institutional order flow. I'll see you in the next lesson. I think that'll be lesson 11, and I'll see you all next time.